Hello, and welcome to the IREI.Q Quarterly Fundraising Report review. Thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IREI.Q database. We'll be sharing some trends and data covered by our Q4 2024 IREI.Q fundraising report, which was published Thursday, February 13th. Today, I will be joined by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I will share a brief slide presentation, and then we'll have a broader conversation about fundraising. We also will be answering questions from the audience through the Q&A feature, which you can access at the bottom of the screen. All the data discussed in the program comes from our IREI.Q database. IREI.Q includes information on organizations, investment programs, and industry contracts, and it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IREI.Q as part of their benefits package. But if you are not a sponsor and interested in using IREI.Q, you can subscribe by clicking on the IREI.Q logo on our website. Now I'd like to welcome Rohit Nerurkar of Mercer and Wendy Pryce of Nuveen. Thank you for joining us. Could we start with each of you giving a brief overview of your roles and where you sit in the fundraising ecosystem and what perspective that gives you on the market? And I'll go ahead and start with Rohit. Rohit.
Hi, Loretta. Nice to talk about this with everybody. I'm with Mercer. I co-lead our North American real estate research team. So we advise our clients, our advisory clients, on should they be making real estate allocations, what funds should they invest in, what sectors they should look at. We also have a large discretionary capital that we also manage as a team to allocate towards real estate strategies.
And Wendy?
Great. Thanks, Loretta. Happy to be here. Thanks for having me. Happy Tuesday. Yes. So Wendy Pryce, I lead the Americas real estate client specialist team. As a part of that, I am primarily responsible for capital raising across North America, so Canada, the US, and a bit in LATAM. Nuveen's platform is about 160 billion of real estate. About half of that is third party. So yeah, happy to be here and happy to represent the views of a large platform, a little different from the consultant.
Fantastic. Let's go ahead and dive in with some of the data. And just a reminder that you can, in the audience, send us questions through the Q&A feature at the bottom of the screen. So now we'll be looking at closed-end funds investing in direct properties, equity, or real estate debt. And for this report, we're sharing data on funds with a final close between October 1st, 2024 and December 31st, 2024. And so it's important to remember that this is a snapshot in time. It is possible additional funds have closed but haven't announced yet. And our IREI.Q team learns about fund closings continuously as the year goes by. And we, of course, update our data accordingly. I still think the overall trends are useful to indicate what is happening in the market and to give some guidance to investors and managers about where we are and where we might be headed. I do say that just so that, for people watching, just have a little bit of an understanding of what we're looking at here. And just to give you sort of an idea, when I presented our data at the VIP Americas conference about a month ago, we had an even smaller amount of data regarding what happened in the fourth quarter, but it's a little bit more complete now. And even then, it's so small. So we're looking at $10 billion raised by 14 real estate focused funds. And that's down from 14 funds that raised 20 billion in the previous quarter, 23 funds with 30 billion in the second quarter. And, I would say about, 27 funds raising 24 billion in the first quarter. Would you describe this as a challenging fundraising environment right now? And I'll start with you, Wendy, because you're out there.
Yeah, sure. My life hasn't been easy. Let's put it that way. So definitely, I've been in the real estate industry for 25 years, and barring around the GFC, I would say this is the second most challenging capital raising environment overall that the industry, has experienced probably in the last 25 years. Now, obviously, just like all good responses, right? That is nuanced and that depends and that has a lot of different factors. But overall, you can clearly see that the amount of total dollars flowing into private real estate, and this only represents closed-end funds, but quite frankly, open-end funds for the last, 2.5 years really haven't seen primary net flows in either. So this number is even more dramatic because in the previous, 2 years before this, the open-end funds would have been adding a lot of capital, to the overall fundraise, but now that's pretty much been taken out of the mix as well. So yes, it is challenging. Now that said, and we'll get into this a little bit later, certain sectors, certain structures, certain niche things, right? If you have a product that is highly in demand or that clients have less allocation to, then fundraising might be a little easier. But certainly it involves a lot more time and a lot more calls and a lot more meetings than this would have, 3.5 years ago.
I want to go to you, Rohit. Can you, kind of shed maybe a little bit of light on your clients' perspectives about maybe why they aren't allocating as much right now? Is there, what's causing them to perhaps pull back a little bit in the market?
Yeah, I think there's a few reasons, and some of them Wendy just touched on. I think everybody knew that there was going to be some valuation correction on real estate overall, and we're seeing it, from the open end side the last couple of years. And so, higher interest rates really drag down valuations. And I think overall, a lot of our clients were putting a pause on doing real estate allocations from that. We're seeing now some positive data, obviously, a couple quarters of the Odyssey Index looking positive. So I think overall, you're hearing sentiment shift. We're having discussions, things like that with a lot of our clients on allocating again. But there was this pause for a bit, and some of that was uncertainty on the interest rate environment. There was questions on, the elections and what impacts that could have, and delaying maybe decisions till after some of that got cleared up. And then lastly, a lot of our clients weren't getting distributions back from previous funds, so they didn't have as much dollars to allocate to the next fund. So all of that combined has really led to waiting right now. But I would say sentiment hasn't really been negative. It's more, hey, let's wait till some of this clears up. So, I guess going forward, I would think that a lot of what we're seeing here on lower numbers might shift towards the back half of this year.
That's interesting. I'm gonna bring a little bit more of a wider view. So this is annual closed-end real estate fundraising, going back 25 years, and you can see this looking at the blue line. Things really peaked in 2020, 2021, and as Wendy, you were pointing out just a moment ago, this is just closed-end fundraising. That was also a real peak in fund flows for open-end funds as well. But when you look at what happened in 2024, we're basically on par with, let's say, 2013, 2014 in the sort of post-GFC recovery. The last time we saw a big decline in fundraising was, of course, the GFC. How would you say the mood now compares to that last decline in fundraising? Maybe, Wendy, we can start, and then I'll talk a little bit with Rohit, too.
Yeah, sure. Look, it's a bit of a different situation, and I would say the mood now is certainly not one of complete and utter confusion or distress or a liquidity crisis, so to speak, right? Some of the mood that we saw during the GFC. So for reference, and don't quote me, but roughly real estate values in the GFC overall went down by about 40%. We're talking private real estate. And during this period, whatever you want to call it, I like to call it interest get-in period, real estate values have gone down about 20%. And overall, there's less leverage in the system and there's less stress. I mean, obviously, we have some asset classes like office that are feeling a bit more pain, but overall, it's a less stress situation. So I would say, really, we just had a bit of a perfect storm, right? And the fact that we did have a 15-year period of, essentially very, very low interest rates, super strong performance on real estate for kind of a 15-year bull run. And then we get to sort of 2022 and performance was good, capital raising was good, debt was good, cheap, and that led to extremely strong performance, which is one of the factors that led to a little bit of the denominator effect, which you heard people talk about 12 months ago, which is essentially all the clients became overallocated to real estate, including our parent company, TIA. So the initial, pullback was a bit of overallocation. It was almost like the curse of strong performance. Then, we had the equities rally and interest rates started to rise. So fixed income became more attractive, equities performing well, real estate, started to take a little valuation decline, not really on fundamentals, right, but driven by capital markets. And we found ourselves at least back in balance. So I think what we're experiencing now is most of the clients are, at or slightly below real estate allocations. However, there's a liquidity situation, which Rohit referenced, where clients just haven't seen capital flowing back from previous commitments, in the last, say, 3 to 5 years. So what we really need is to unlock the transaction market, which is starting, right? I think people have accepted, rates are probably going to be higher for longer, right? And the valuations at the level where the buyer and the seller and the general market believes that they're fair, which seems to be about now, right? We've seen 2 quarters of stabilization on the indexes. Transactions can flow, liquidity starts. There's capital on the sidelines that gets invested. The money on the closed-end funds comes back. Redemptions are starting to be serviced on open-end funds. Some of that will be rescinded. And then we're a little bit back in business, right? So that's kind of where we are in the cycle. But like Rohit, I believe there are green shoots, right? We don't have overallocation. We're at acceptable valuations, most people tend to believe, and liquidity is starting to flow. So we are starting to see new allocations into real estate as an asset class.
What's your perspective on that, Rohit?
Yeah, I mean, I would agree with everything Wendy just said. I think there was a lot of lessons learned for the industry as a whole following the GFC. And I think, Wendy mentioned it, a more conservative use of leverage, for one example, better managed balance sheets as another, just in general, I think those lessons learned have made this a very different environment than previously. So I'm hearing the term cautiously optimistic a lot from our clients as they're looking at real estate allocations. And I think, that's a mood that might be slightly different than it was in prior cycles.
I want to go to our next slide. This looks at average fund size at the time, per quarter. And, the funds that held a final close in the fourth quarter were actually a bit smaller than we've seen throughout the year. That one second quarter 2023, which is quite an outlier, big part of that is related to a large Blackstone fund that closed in that quarter. So, that's definitely going to sort of push overall sizes up. I actually think that the small size of the fourth quarter is probably just a blip and not part of the overall trend. Does that sort of match with your sense that funds overall have been getting bigger? Or maybe it's only the biggest funds that have been able to achieve a final close? And maybe I'll start with you, Rohit, on your sense of fund size and trend there.
Yeah, I think that I would agree with you. I think this is a blip. I think a lot of the bigger funds have probably been the ones that have line of sight into more capital that can come in and have kind of extended out their final closes a bit more. So I think what we're seeing is probably more of that rather than a trend downward on fund sizes.
Any thoughts on that from you, Wendy?
Yeah, no, I would agree. Look, there's always going to be the mega funds which skew the numbers. For those who like retail investing like I do, I call it the Apple store, right? You can't look at any retail, any mall or strip malls sales, if you include Apple, you got to take it out, right, to see what the real volume that they're doing. But I would say the recent trend toward larger funds is clearly when there's a liquidity crisis or a shortage of capital, investors will always tend to re-up to their existing funds first, right? Because that's your first core to order. And then any extra money or money for new capital, new ideas, new niche things, that tends to come afterwards. So now that capital has been a little bit more tight, clients are sort of reverting to say, okay, we're going to re-up with the managers that have come back to the market. Some of them are bigger funds and some of them are previous funds, which might be on the third or the fourth or the fifth series of funds, which doesn't leave as much money for the newer, smaller, more niche managers and asset classes. So it's a little bit unfortunate, but that's the way of the world. I was in New York at the 4 days of emerging manager conferences last week. And a lot of them were coming up and saying, hey, life is tough. And life is tough, right? If you're a small new manager right now and you're on your first fund, yeah, you're going to have a tough time. And that's just because of the lack of liquidity that, they're going to have to preference the re-ups first.
Certainly, looking at the funds that did hold a final close, the vast majority of them were on a second, third, fourth, seventh in a series, and those that weren't were from very large, well-established managers. So it does seem to sort of suggest that there is more of a challenge. When it comes to re-ups, have you seen even that kind of take a little bit of a pullback in activity? You said that managers are clients are prioritizing re-ups, but maybe Rohit, are even those re-ups seeing a little bit more stress or a little less likely to come through?
Yeah, I would say what we probably noticed more than somebody not re-upping is smaller bite sizes than maybe they were doing in 2021, 2022. The other trend we're noticing is that a lot of our clients aren't necessarily seeing the benefit of coming in on that first close for a 25 basis point fee reduction. They'd rather wait it out, see if there's a bit more clarity towards the end of the fundraise, see what a seed portfolio looks like. So I think our clients are definitely valuing that optionality a bit more than maybe a few years ago.
Yeah. And just a reminder for the audience, if you have any questions you want to supply or pose to our panelists, we do have a Q&A open, and I will be posing those questions as we go through the conversation. I'm going to bring up the regional market focus over the past 12 months. This is looking at where these closed-end funds are targeting to put their capital. And, the vast majority does seem to be aimed at North America. In particular, in the most recent quarter, we saw 7 funds raise $5.5 billion to invest, and that was a little over half of total capital raised. With that said, do you think the U.S. maybe is the most attractive region right now for investors, or what is maybe pulling all this capital in this direction? I'll open it up to either one of you to grab that one.
Well, sure. I'm happy to jump in. So I like to love all my children equally, but I've been to a lot of events and keynotes and economists and CNN anchors, and I would say typically overall, barring real estate, that the U.S. right now is viewed as a bit of a safe haven, right, in terms of economic growth, security, safety, everything, right? So I just think the U.S. overall is presenting itself as the stronger economy, and my colleagues in Europe and Asia are going to beat me up, but I'm quoting, economists and CNN anchors globally who are just saying, look, the U.S. is more attractive in terms of where the capital flows are going. You add on top of that, strength, right? Fundamentals have been good. There's still population growth. There's still, immigration growth. There's just macro signs that things might continue to go well for a little while. And I think that Europe and Asia, people were a little more skeptical. I mean, the US has always been the biggest market in terms of allocations of the market dollars for real estate, so that's not abnormal. But we have certainly seen even more of a shift toward US funds than we have in previous years. And I just think it's all the uncertainty and people figure, okay, if I have less dollars to allocate, I'm going to go to the market where I feel the most comfortable.
Yeah, I'd add in that we have teams also in Europe and Asia looking at strategies there, opportunities there. A lot of the same demand drivers, fundamentals that we're seeing play out in the US, there's similar opportunities in some of those other regions, demographic changes, some shortages in certain sectors of good new product like industrial in Europe. So we're seeing opportunities in other places as well. I think to Wendy's point, the US has always been the biggest market. I think what we're noticing from our client base is that our US specific clients are really looking to make allocations in the US, sometimes global through a global fund, but not really a regionally specific fund in Europe or Asia. But we have clients in some of those other regions that are allocating dollars to US specific funds. So I think that dynamic also might be playing into some of these differences that you're seeing.
Yeah, the US investors tending to have a pretty strong bias toward their domestic market compared to others.
Right.
Obviously, closed-end funds, as everyone knows, tend to focus more on higher return strategies. We can see that continued. Here's a breakdown over the last 12 months by strategy. Typically not disclosed. Many of those funds are focused on real estate debt, just as sort of a FYI to the audience. In the fourth quarter, funds targeting opportunistic investment raised $3 billion. Funds with a value-added strategy raised $2.6 billion. And funds with sort of a core plus or a core plus value-added strategy raised about $1 billion. So again, we're definitely seeing a stronger interest in opportunistic, followed by value-added, followed by more of the core plus space. We didn't see any pure core funds close in the fourth quarter. Any reactions to this? I also have some questions from the audience to pose, so I'll kind of see if you have any sort of sudden insights off this, or is this about what you would expect?
I think that this would be, what I would have expected. Obviously, I think you mentioned this does not include the open-end side, which makes a difference. Obviously more open-end for the core and core plus side. But I think what we're seeing overall from these different, I guess, risk profiles is we're seeing an interest again in having discussions on kind of the core plus side. Definitely a good entry point with the valuation kind of adjustment we've talked about that's happened over the last couple of years. We've typically seen more interest recently in core plus over core. Just I think you can access the same demand and market fundamentals and just get a higher risk adjusted return. We're still seeing a lot of interest overall in value-added opportunistic strategies. There's been a discussion the last couple of years on wall of maturities and all this distress coming. I think maybe it didn't play out exactly as everyone thought last year, but I do think that there's still going to be some distress in the market and there's going to be a lot of opportunities. So I think it's going to be a good vintage for a lot of the funds that are out fundraising right now.
Yeah, I would agree. This doesn't surprise me. And obviously we haven't included open-end funds, which tend to be more on the core plus side. Look, we had a relatively long period of, stabilized interest rates and growth and strong performance. And, pre-interest rate get-in, core plus returns were, looking very favorable on a risk-adjusted basis. And there wasn't a lot of it's probably not the best word, but perceived distress in the market. And it was just harder to go up that spectrum, right? Because on the opportunistic side, there were probably less opportunities. Now that we've had a bit of a rate shift, and debt is more expensive, on the core side, you have to make sure if you're going to take negative leverage, right, and you look at your yields, that you really feel good about NOI growth and that you can grow, into your debt levels there. And on the value add opportunistic side, that's where we've seen more of the trends, because clients say, look, I want to take advantage of the current cycle where there might be more opportunities, there might be some liquidity crunch, there could be some assets that have expiring debt that we could provide a solution for. So we've seen a lot of secondary recaps, GP positions, just anything that's a little bit less vanilla that tends to be not core. But I agree with Rohit. We're certainly starting to see clients very active again in the core plus space, probably a little bit less on the super core, just because pricing is now at the level where you might say, you know what, I can pick that up at cap rates at 250 basis points above 3 years ago, and I'm a long-term hold, and they're starting to open up to that too. But certainly value add was more the flavor of the day for the last 2 years.
I wanna bring in a couple of questions from the audience, and I'm actually gonna kind of combine a couple of them that have come in. Can you kind of weigh in a little bit on, the interest that you're seeing in the market, niche strategies versus sort of the four main food groups, and also maybe we can also talk about sector-specific strategies versus more of a diversified strategy. What are you kind of seeing in sort of investor interest related to those? Maybe we'll start with you, Rohit. Are investors looking more for sector specific or diversified? Are they more looking at sort of niche strategies or sort of the four main food groups as you're talking to investors right now?
Yeah, so Mercer, we have a wide variety of clients that look at real estate. So, maybe I'd say some of our clients that have less of a robust real estate program or allocation to play with, making one or two allocations a year, they're still looking for just a diversified fund to allocate to. Some of our clients that are a bit more robust and have maybe more on staff focused to real estate, just have more money to allocate, they tend to look more for sector specialists, and they think that there's an opportunity to get alpha more from somebody that really knows the specific sector, has specific operators, or vertically integrated. So I guess there's a difference, I guess, in the type of client for us than what they're looking for. Overall, I guess the second part of your question on the alternative sectors, we've definitely seen across our client base more of an interest in alternative sectors. And, even on the open-end side, the Odyssey Index shifting a bit to allow some of the core managers to invest in some of these alternative sectors has made that market change a bit, also changes who's buying some of these on exit and everything. So overall, I think we're seeing a lot of interest. There's a lot of strong demand drivers and market fundamentals for a lot of different sectors, and a lot of interesting opportunities in some of these alternatives.
Wendy?
Yeah, I think it's very nuanced, right? It depends on your current situation as an investor, your size, your size of your team, your ability to underwrite, whether you work with a consultant, your current allocation, all these factors. I would say generally in the four food groups, office is probably the least. People are not jumping up, intending to increase office allocations. Now, that said, there are several large, savvy, well-staffed groups that, I just had 3 conversations last week about groups saying, hey, we're ready to play. Distress again is a strong word, but office opportunities where we really think we can capture yield. I mean, you could buy decent offices now at 10.5 yields, right? You could say it's a once in a lifetime opportunity. Now, some folks are staying away just because they're saying no office, I'm over allocated. So it depends on your situation. Retail is another interesting one. I've been in this business 25 years, and basically for the first 10 years of my career, I used to work on the acquisition side. I bought office and retail. And, in the last 15 years, retail has been a bit of a 4-letter word, right? Now office is kind of replaced that. So all the retail people are dancing and singing. But, when you look at allocations to retail at this point and valuations and where we are, most clients are, less than 5% of their real estate portfolio is allocated to retail. And again, some of the yields still look attractive. So, in a nutshell, retail is back. And we have plenty of clients that are clamoring to get, retail exposure, especially if you've sort of taken office out of the mix, right? It's another chunky asset class where you can put out dollars. Industrial, great. I mean, look at the fundamentals, right? There doesn't seem to be a slowdown on the uptick of the e-commerce tailwind, so to speak. But then again, a lot of clients spent the last 10 years, building their industrial allocation. So some of them are a little bit full. That doesn't mean that it's not a great asset class. And, there's still performance drivers to come. I would say clients say it's probably not going to be a 40% per year for the next 10 years, right? But it's solid and the fundamentals look good. And especially if you differentiate between light and bulk and location. The same with housing, right? Some markets, I mean, down to the zip code level, right, have some oversupply, and some markets are growing like gangbusters. We've seen some clients, want to get more exposure to the housing alts like student SFR, manufactured housing, now a resurgence in senior living. So yeah, the food groups are nuanced, and it really depends how big you are and what your allocations are. But certainly niche, I'd say over the last 10 years has been consistently becoming a larger percentage of investors' overall portfolio. And especially in the last few years where there was more uncertainty, we saw some niche allocations like affordable housing. It's a great, downside inflation protector, right? You saw, I mean, data centers, we don't even need to talk about that, right? But if you start from close to zero allocation, yeah, and investors want that. So it really depends, what you have and what it is and where people are in the cycle. And, is a 2 billion endowment going to do a 2 billion data center commitment? Probably not. But so it's nuanced, but I do think you're just going to see more and more exposure to the niche, and a lot of the niche will just become mainstream. And overall, look, there are plenty of clients who want diversified funds, but I would say overall, the more sophisticated clients become, the more sectorized they make their investment decisions because they want to control a little bit more their allocations on their own portfolio.
While we're talking about property types, I did get another question from the audience, just asking investors' sentiment for hospitality. It's a property type that neither of you have mentioned so far.
Yeah, we haven't had a lot of direct interest in it. There's been some challenges overall. I think that there's definitely pockets of opportunity. Limited service seems to have been doing a bit better, maybe high-end resorts as well. It's really maybe in that middle area that struggled a bit more. So there's definitely opportunities and that we'd assess and look at overall, but maybe not as much client interest clamoring for it as some of the other sectors that we've discussed.
I mean, hospitality, it's very interesting in that I think over time people have come to view it as you better like an operating business, and obviously you own the real estate and you have an operator, right, a Marriott or whoever, but you really got to understand what you're getting into. And I think there's been a little bit of a concentration, right, to the specialized hospitality investors that really understand the back end and some vertical integration of the business. But hey, if you, like I said, I mean, you got to a situation similar to retail where hospitality is a very low portion of most investors' allocations. And we certainly have clients ask us, especially the bigger ones that are more opportunistic in their allocations, and hospitality debt, right? Like you could actually get very good, attractive, lending on hospitality now. So if you're in the debt space, your manager's probably doing a little bit of that. So it depends, debt, equity. It's certainly not dead. I think it's just become a little bit more eyes wide open.
Let's move on to the next slide. Quite apt of you to be bringing up real estate debt. This is a look at closed-end real estate fundraising by debt funds compared to overall fundraising. So that smaller, darker blue is the debt fundraising as a portion of overall real estate fundraising. And you can definitely see that as a portion of overall fundraising, we've seen an uptick in the interest in debt. It does seem to coincide a little bit with the rising interest rate environment. Is there anything else you might think about? What are your thoughts on real estate debt fundraising in this sort of current environment? Rohit?
Yeah, I mean, so at Mercer, we've had a favorable outlook on real estate debt for some time. I think there's a lot of market dynamics there that tell a good story, right? Once in a cycle opportunity. A lot of the traditional lenders are kind of pulling out of the space. You can maybe before had said that this was like an 8 to 10% return target. Now you're looking maybe more mid-teens, and so you're the story's there, and it's interesting. Again, that wall of maturities and everything. Especially if you are raising a fund now and don't have exposure to some of those loans that were underwritten a couple of years ago, you should be able to do really well. Overall, our client base maybe hasn't really allocated as much dollars to the real estate debt space, even with us having a favorable outlook on it and kind of pounding the table a bit, saying, "Hey, this is a good opportunity." I would say one part of that, I think some of our clients have a bit of a bucketing issue sometimes, where it might sits a bit in between the private debt bucket, the real estate bucket. The return targets and profile might make a bit more sense in the private debt bucket. Obviously, you can make the argument that it's underwritten by real estate, so it makes more sense in the real estate bucket. Sometimes our clients end up just throwing up their hands and not moving forward when it kind of sits in that in between. So overall, though, I could see this continuing to trend up, but it's just one of those more difficult aspects of fundraising for a real estate debt strategy.
Yeah, I think you nailed it. I mean, we certainly have seen an uptick in our own platform and our own capital raising toward real estate debt. And one could argue that, maybe until the point where valuation stabilized, that real estate debt was offering a very good risk-adjusted return basis compared to real estate equity. Didn't mean real estate equity was bad. It just said, hey, if you're a kind of stabilized investor and you're just looking for yield, right, it might have been the flavor to go. And just overall, even real estate debt, just private credit in general, the last 3 years have been a heyday party, right? There's been a lot of money raised in private credit, including real estate, but probably even more on the corporate side. And I think with real estate, one of the nuances is exactly right, Rohit alluded to. A lot of clients don't really quite know where it fits yet. And if they are going to allocate to credit, they tend to go on the corporate private credit side. And some of them put it in the real estate bucket, some put it in private credit, some put it in their overall fixed income allocation. But clients are seeming to get a little more organized around how they want to attack private debt. And I do think you're going to see a steady, consistent, popularity, especially if interest rates remain high. And especially many lenders have returned. But, there was a few year period where your traditional lenders for real estate just weren't in the market, right? They were over allocated. The balance sheets were full. The regulators were coming down on them. You take insurance companies and banks, and now some of that's worked its way through the systems, but these private credit funds were really stepping in to fill a void. And now it's almost created a whole other lending sector that's just going to become mainstream. Right, a lot of debt is being provided by, real estate debt funds, both in the senior, a little bit less, right? Those tend to be, more direct, but in the mezz space and transitional loans. So I think it's here to stay for a while.
I'm going to go on to our next slide, which is our last slide. Just sort of key takeaways. I'm not going to read the slide, but it will be in the slide deck people can take a look at. Instead, I just maybe think it would be a good moment to kind of ask both of you, what are your expectations for fundraising going forward? What do you think 2025 is going to look like? Will it be different from 2024? And what do you think might be driving that? And I'll go ahead and start with you, Rohit.
Yeah, I mean, I think for a lot of what we've discussed already, trends that we're seeing a bottom in valuations, things like that. I think the back half of this year we'll definitely see a pickup overall. So I think positively, if you're looking, compared to 2024, I think you'll see a pickup in fundraising and allocations. But I think if you maybe broaden that scope out a bit more and look, at some of the heights of 2021, 2022, I think it'll be tough to get there. I think, higher for longer interest rate environment is probably here. We're not going to get maybe all the way back to what we were seeing a couple years ago, 3-4 years ago. So I think we'll see upward trajectory compared to 2024, but maybe not quite back to where we were previous to that.
Yeah, no, I would generally agree. I would like to say that I think 2025 certainly can't be worse than 2024 overall. We've seen values start to stabilize. We've seen transaction volume certainly picking up already. I saw a question about Qs, right? We've seen Odyssey Qs come down. I think right now they're about 15% of NAV. And at one point they were up to close to 20% of NAV. So liquidity is working its way through the system. There's no doubt about it. It's going to take a little bit of time. So like Rohit, I expect the second half of the year is going to be more active than the first, right? You've seen a lot of fundraisers come to market kind of between the end of last year and the beginning of this year. You'll see a lot of those re-ups, right, that might have been on the sidelines, like Rohit mentioned, start to say, okay, now we're 18 months into a capital raise on a closed-end fund. Maybe they're going to come weighted more towards final closes. So it will get better. Again, are we going to go back to 2021 peaks? I don't know. I sure hope so. Because I was hoping to retire one day, but I guess I'll be working for a lot longer. But look, I think, overall investors, they're not decreasing their allocations to real estate overall. In fact, some of them are increasing. So, you are seeing slight uptick in real estate target allocations. But some of that's going to be nuanced, right? Is data centers included in real estate? Sometimes it is, sometimes it isn't. It might be infrastructure, it might be real estate, private, now real estate debt. Is that included? And overall, you're just seeing more competitive for the capital. I mean, a couple of the big plans that I won't, call out, but I can think of it three super huge global investors that just announced kind of a real return analysis, profile where they're going to look at every asset class against every other asset class and slip away from, hey, we're going to do, X amount of pacing and real estate gets this much and fixed income gets this much, right? I just think you're going to see an overall more sophisticated, especially with AI, the available of transparent data. There's just more and more data available to say, okay, I want to compare my real estate to my private equity, to my VC, to my listed REITs, to my my venture. And in the end, it probably all evens out. But yeah, we're probably going to see better, but probably not another 2021, at least for a little while, just because of rates and a little bit of pressure on values.
Your comments actually make me want to ask another of the questions that we have from the audience, and I'll start with you on this one, Rohit, as well. Do you think, looking at your clients specifically, are investors rethinking the role of real estate in their portfolio more generally, given interest rates, illiquidity, the challenges in the performance? Do you think that could lead to lower allocations to real estate overall as investors rethink the role of real estate?
It's a good question. I think overall, I would say a lot of the clients we work with, we're probably pretty aware of the situation where with open-end funds, when you need the liquidity most is when it's difficult to get it, right? So I think a lot of our investors lived through some of the challenges of the GFC and other times, and that liquidity was kind of crunched. So I don't think that there's maybe re-underwriting of real estate from that point of view. I think a lot of our clients understand it, know what they're dealing with. So I think from that point of view, probably not. I do think that some of our clients are looking maybe at their alternative asset classes as a whole, private equity, private credit, infrastructure, real estate, and just thinking more about what is the goal of that portfolio, right? Is it I think a lot of our investors are looking for higher returns from that bucket, right? So I think what I said earlier about better risk adjusted returns in core plus versus core, I think you're seeing shifts like that, maybe more nuanced rather than a big structural shift saying, hey, no, smaller real estate allocations, anything like that. It's more, hey, let's make sure what we're doing is getting the right returns that make sense for us given the illiquidity premium, blind risk pool, things like that. So, yeah, overall, I wouldn't say it's like a major shift.
And this is coming from another question from the audience. Given this difficulty that we're seeing for investors to get distributions, what are your expectations for secondary activity in the coming year? Do you think in particular LP-led secondaries are going to pick up in the year ahead?
I'm happy to take us. Oh, go ahead.
Yeah, I would just say, yeah, we've definitely seen more clients ask us. We're seeing more opportunities come from brokers and things like that on clients looking to sell, clients looking to buy, anything like that. So I think this environment can make secondaries make a lot of sense. And I think a lot of our clients are taking another look when maybe historically in the past, they haven't really looked at real estate secondaries as an option.
Yeah, I would agree. I would say secondaries in the last 3 years, if you were a secondaries broker, you should be on your yacht right now because that was the most action we'd seen in a long time, since the GFC, right? And if I don't have the slide here, but Loretta's seen the data, but the secondary transaction markets were very active. We've seen a little bit of a taper off. It doesn't mean they're not still available, but the bid ask is coming a little tighter now that the valuations, people seem to feel a bit more comfortable where we are. There's more trades, right? So there's more comps, and we're just seeing that bid ask get tighter. So a lot of times, we're just not at the level where the secondary buyers want to transact. So we've seen a little taper off on the activity, but certainly when there's liquidity needs and there's some sellers that just want to generate liquidity. I think those markets will stay, pretty active until for a while, better than they were in the last 15 years. So it's certainly a space to watch. But I personally think we've seen the secondary market peak probably last year or the year before, and now we'll still see activity, but not quite as high as we saw when pricing was bigger spread.
We won't know what the secondary people are saying because they won't be watching this webinar as they are on a yacht right now.
They should be, or calling people about, I get secondary transaction listings from about 17 different brokers where they send me, hey, here's everything on ask, here's everything on bid. And it's certainly active, right? Like I said, 4 years ago, those emails were a lot shorter and those emails got to be pretty long, and they've shortened a bit, but there's certainly no shortage of available bid and ask in the market.
I have a couple of questions for you, Rohit, that a little bit of a callback to one of your comments earlier about the sort of investors being a little bit hesitant to come in at first close, waiting a little bit longer. So a couple of questions. What kind of incentives are you seeing that would get investors to move on to a first close? What kinds of investors are still interested in being first closers? And then also, where are you seeing founder fees for new vehicles?
Great questions. I would say one thing I've noticed that might be a bit different than what I've seen previously is we've seen some offers of GP stakes, kind of sharing a promote, things like that as an offer on a founders round, first close, to help incentivize people to come in. I would say generally in the past, we've seen the 25 basis points kind of be roughly of a discount that you could get for a first close. It seems like what I was trying to say earlier was it seems like that isn't enough anymore. So I haven't seen a ton of data to show like bigger ones are leading to more of our clients kind of drawing interest. But from what I've seen is that 25 basis points isn't enough. So I would guess that they would need at least a bit more than that to start considering coming in. But some of this can change also if the market environment kind of switches a bit. So right now, I think there's a lot of our clients want more of that line of sight into seed portfolio, waiting out this interest rate environment, things like that. So right now, 25 basis points not enough, but maybe that changes.
People love to ask questions about pricing. So another one is typical discounts to NAV for secondaries.
Yeah, that's a good question. I think what Wendy said with what she's seen overall is with the spreads coming in has been sort of what we've seen. Maybe 6 months ago, we were seeing anywhere from a couple percentage points of a discount to 5, 7, 8, 9%, sometimes even closer to 10. I think now we're really seeing more in that 1 to 3% discount for anything that we're really looking at more closely.
Yeah, I would agree. And sometimes even tighter, right? I mean, sometimes it's really down like 0.5, right? It's just a lot tighter than it was. I mean, 3 or 4 months ago, there were certain, well, 3 or 4, maybe 3 years ago, 2.5, there were certain funds you could take at 40% discounts. Just people were desperate for liquidity and there was a run for the door on some of the open-end funds, but you're not really seeing that anymore. And on the first closers, I'll just add, I think you nailed it, Rohit. We're in a bunch of capital raise periods now, right? Because a lot of managers have come back to the market now based on the vintage and based on the fact that the previous funds have now been able to be invested because the transaction market have opened again. The issue is a lot of those investors haven't seen liquidity from the previous vintage, and the managers have come back and said, hey, this is a great vintage. This is the time to be out. We're now 70 to 100% vested on the previous one, which took longer to put out than we would have liked, but now's the time. So I think, it really depends on the relationship with the client, right? If the client has been a backer of the platform for a long time, right? Like typically in a first close, they'll want to back the platform because, it's a little bit of a lemming strategy. You need to show a solid first close in order, and it's better for them, right? Because they want the fund to be bigger for their own concentration risks. But yeah, getting a bit more creative because honestly, just management fee discounts aren't really going to cut it because if you don't have liquidity, you don't have liquidity, right? So we've been doing a lot of liquidity planning on other funds and saying, hey, we're going to model out for you exactly. You never know exactly, but what we believe is going to be the liquidity. And if we can get money back to you, can you kind of soft commit it to the next vintage? A little bit of cross-pollination, more across the platform with fee discounts across multiple asset classes, across multiple vintages, maybe next vintage funds. You have to think a little bit outside the box. Because if you're going to entice a new investor that's new to the platform into the first close, yeah, it's got to be something a little bit more interesting than, hey, 25 basis points on the management fee.
One of the things that just keeps coming up this year about the challenges is just that we haven't seen the level of distributions because we haven't seen the transactions. And I've actually had a few questions come in asking more or less when would you expect that to change? Like when do you expect meaningful distributions to pick up from closed-end funds? And when do you see that sort of return of capital? Maybe Rohit, do you have any visibility there?
Yeah, I mean, I would just say what Wendy kind of highlighted earlier is really the driving force here. The transaction market really needs to pick up, right? We're seeing signs of it. Obviously, we mentioned earlier, sentiment's definitely picking up, right? the transaction activity is picking up as well, but maybe still a bit muted from looking at previous periods. But that really needs to pick up, and there's positive signs there. But until that really shows more of a sizable gain, we're not going to see distributions, and that is really the driving force. My guess is if we still have this kind of positive sentiment, the transaction market will pick up, and we'll start seeing more activity towards the end of the year.
Yeah, I mean, look, debt is available. Fundamentals are still hanging pretty strong. Most construction stopped over the last few years, right? So we haven't had, I mean, I'm generalizing, but we haven't had a lot of development, right? So supply is probably oversupplied in certain markets, but overall is less than we had 2 or 3 years ago coming out of the ground. The elements are there, right? Valuations seem fair. The valuers now have more comps, right? So and buyers and sellers are both more realistic because they've had 2 years to absorb the current state of the world. So I think, a seller's now like, all right, I'm probably going to have to sell it at this price. And the buyer's like, all right, I guess that distress that I expected is not coming. I'm not going to be able to buy, Class A multifamily at 15 cap rates, darn. So, there's just going to be more of a willingness to transact. And I think that investors are putting pressure on the managers and saying, look, like, give me my money back. And when that starts to happen, people tend to react. So I think you will see it. It's the recipe's there, right? We just got to get in the kitchen now.
Well, I think we're coming up on the end of our hour. So as we begin to wrap up, maybe each of you could sort of just kind of hit on your key takeaways about the real estate fundraising environment, and what maybe the audience should take away from this. Wendy?
Sure.
Key takeaway.
So if you're a young capital raiser, no, you should not consider changing your career completely. Look, I've been through a couple of cycles, and at the end of the day, I think you have to take it in stride, and you have to stay, planted, realistic, right? This is not abnormal. There's no cause for fear. There's no, major distress, or we're not having a liquidity or a total breakdown of the economy like we had in the GFC. So you adjust to the new norm. And I like to think of it as a positive in that, real estate is now actually back to the real estate, really, where in the last 15 years, it was a little bit of a capital markets play. And quite frankly, you probably didn't have to be as good as a real estate investor to generate returns. And for the long-term players who've been in the business for a long time, have seen cycles, stay the course, and just, do what you're supposed to do, it's going to be fine. And it's actually probably going to be better because there will be consolidation, and the investors that were not that great will probably be weeded out. And at the end of the day, AI, all this stuff, right? You can, there's senior people in my team. We always say, well, there's a lot of stuff you could do in the virtual world, but you can't live, you could kind of shop, but you still need someplace to put all that stuff. At the end of the day, we need physical real estate. The population is growing, and it can't go away. We're not making more land, and it's going to continue. So we're all going to figure it out, and it is not disappearing. So anyone on this call probably has a nice long career of real estate in front of them before we all move to Mars.
Rohit?
Yeah, I would say, echoing a lot of what Wendy just said, I think overall we have a favorable outlook on a lot of the real estate fundamentals out in a lot of the different sectors. Obviously, some sectors more challenged than others, some markets more challenged than others, but a lot of the difficulty has been more of a capital markets reason rather than a real estate reason, which I think should give some comfort as some of that can, gets more settled or stabilized in the next 6 months to a year. So overall, our clients, the sentiment is maybe not as negative as what the lack of dollars makes it seem. And we're starting to have discussions, and maybe the discussions leading to dollars isn't as quickly as everyone would like, but I think the fact that those discussions are starting should be something that should be viewed positively. So overall, I think, better times are ahead.
Well, I would just like to thank you all for joining us. I'd like to thank our panelists. I'd like to thank our IREI.Q Data Services team, Director Karen Palma, Nico Pepis, rest of my colleagues for putting together this information. And just as a reminder, all of the data discussed in the program comes from our IREI.Q database. IREI.Q includes information on organizations, investment programs, and industry contacts, and it tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Our publication sponsors receive access to IREI.Q as part of their benefits package. If you are not a sponsor and interested in using IREI.Q, you can subscribe by clicking on the IREI.Q logo on our website. Our next IREI.Q fundraising report review will cover first quarter fundraising, and the webinar will take place May 13th. Thank you and have a great rest of your day.
Thank you.
Thanks.